So one of the bigger objections we've been getting lately on the asset-based long-term care, it's coming back full circle again, where people are comparing it with the S&P 500 index. And it comes and goes in phases, okay? Because when the markets are down, they definitely don't compare it to that. But the markets have been booming. And they're like, you know what? If I took those same amount of funds, like I have a guy, I haven't even emailed him back yet, but I need to. We were proposing a plan for $18,500 a year for him and his wife. It's a joint policy, One America Asset Care. And the reason why I chose Asset Care to initiate the conversation is because they're looking for the biggest bang for their buck, and they're both married and they're both decent health. So that makes the most sense right there. Biggest bang for the buck, both married. Asset Care is going to be number one in most all situations, especially considering their age. And so I started thinking to myself, wow, I haven't heard these objections in quite some time. I mean, we get them all the time with annuities, but not so much on the actual long-term care. So I'm going to share with you a couple examples here. I'm going to share my screen first. And this is how we want to look at the math on things, okay? So if we come over here, oh yeah, here we go. Let's do S&P 500, all right? And we've talked about other ways to compare stuff too on this, but S&P 500, if we take a look at 1 year ago today, now, by the way, this conversation is going to help you with annuity sales, life insurance, because people all the time, I had a lady call me yesterday, a client of mine, for 14, I don't know, how long has she been with me? It was like my first or second year in the business, so close to 13 or 14 years. And she goes, I want to cancel my life insurance policy because I can do better in the stock market. And I said, you absolutely can do better in the stock market for the purposes of cash to cash return. I mean, that's just the math, right? You can do way better in the market and you have full liquidity of it. There's very little fees if you use like Fidelity or Vanguard. And then I asked her, I was like, what happens if you take that money? It was like $200 a month too, like big deal. But if you take that money and you reposition that into the market, and then you die a year later. So that's $2,400 in a basis, what you started with. And let's say it grew 10%. So you got $240 in interest, and then you died. What is your family going to get if you pass away? She goes, well, they would get the $2,400 plus the $240 in the interest that I earned. I go, yeah, that's awesome, right? I mean, they get to, and they don't even have to cash it out. They could just take it in kind shares and keep reinvesting it. Sounds like a pretty good deal, right? She goes, I guess. And I go, well, would it be better to have $2,400 plus a little bit of interest? Or would it be better for them to get the $3 million check? Because that's what her cover, that's what she could buy at her age with $200 a month. So would you rather get $3 million guaranteed to the family, or the $2,400 plus a little bit of interest? Which one would be better if you passed away? She goes, the 3 million. I go, yeah. And you know what the cool part is? The 3 million, you know how much they're going to have to pay in taxes on that? She goes, no, I'm not sure how much. I go, nothing, because it's insurance. It's not an investment. So, and then she started really thinking. She goes, oh, wow. I go, here is the way to do it the correct way. And you can do it however you like, right? I'm just an agent. It's your money, your life. Your family's going to have to deal with the consequences if you pass away, and however you set up your pre-planning. But let me give you some perspective. What you should have is a foundation. When you go to build a house, are you going to build the roof first, or are you going to work on the foundation? She goes, the foundation. I go, great. So you need to have a solid foundation built out first. Once you have the solid foundation built out, then you can start building the walls, putting the windows in, and then the last part is building that roof. So think about it with financial planning, okay? You need to protect your household right now, because what you're trying to do is just invest into the market and get a higher return for future gains and then retirement, which is, there's nothing wrong with that. And by all means, you should do that. But you also have to protect that asset. So if you put some of that money aside and get insurance, so if something were to happen to you, then that asset is also protected, and so is your family. It's the least expensive way to get the most amount of coverage is through insurance, because it's not an investment, and it's 100% income tax free. So let's look at it in a different perspective. You have $100,000 built up over the course of 5 years, and you never bought the insurance, and then you get terminally ill, or you have a critical or chronic illness, And then you actually need to use some of that money. Now you're going to be depleting that money to help offset and pay for costs, right? They go, yeah. And then so that's going to take away from your retirement funds. It's also going to take away from your family in the form of legacy. See, the reality is you're going to spend the money one way or the other, and your family's going to spend the money one way or the other. It depends upon where you actually get the money from. So in that same situation in the future, and you have this $100,000, let's say that you don't end up getting terminally or critically or chronically ill, but you just pass away. Your family gets a $100,000 check. Do you think they're going to just hang on to that investment and keep reinvesting it? Or do you think they're going to probably spend that down, pay taxes, and then use that money to help support the household, pay the bills, the kids' schooling, college tuition, babysitting, your cell phone bill, or not yours, you'll be dead, but everybody else's cell phone bill and cable and everything else, the mortgage. Like, yeah, so they're going to have to rapidly spin that down, depleting it anyway. So wouldn't it make more sense? And I tell people this straight up, whether or not you buy it from me, that's totally fine. You could go online and try to buy it. You're just going to get a salesperson that is on a quota. And if you don't want it all, that's cool too. It doesn't hurt my feelings. But if you do want it and want the protection, I'd love to be your person to help you with that. But wouldn't you rather have the family get a tax-free lump sum check that they could pay off everything that they needed to and to replace your income as if you were still here? And she goes, that makes more sense. But I really want to invest into the market and diversify. And I said, no problem at all. How about we look at another solution? What if you put $100 towards the market and then $100 to protecting everything in your life savings and everything that you've built up so far? Would that make more sense? She goes, yeah, that makes sense. So we ended up helping her with a $100 a month term policy. Something's always better than nothing for the client. And did she get the full robust coverage limits? No, but she has something that makes her feel better. So now if she passes away, her family's protected and that money can be used and built up. So again, a lot of people try to say, I'm going to invest the difference, I can do better. And you always want to be agreeable with them and say, yes, you absolutely can for the purposes of cash to cash returns. You're going to do way better than buying an insurance product. Even if you buy an IUL or a whole life policy, you're going to do better historically, mathematically, and statistically by just buying an index fund, even with the ups and the downs. Because if you really understand how index universal life works, or if you've ever sold a policy and you've done annual reviews for the last decade plus like I have, you'll see that the annual reviews and the statement values aren't nearly as good as what that illustration portrayed, okay? But you got to get people to understand the differences. And when you explain it to them, you say, look, it's totally up to you. My job as an educator, I want to give you some different perspectives to consider. And then they start really soaking it in and thinking about it. Another live example that we use with a client was, again, S&P 500. She was paying $750 a month into a permanent life insurance policy because she wanted cash value potential. She also wanted death benefit and some living benefits. And she's been paying for this thing for like 8 years. So she's got a significant cash value built up. And we had an annual review call. I said, hey, look, what's the purpose of this money? What do you want accomplished? Because she reached out and said, I want to drop it down to like $200 a month. I'm like, well, that's going to affect the cash and the coverage and everything else. So why do you want to do that? She goes, I can do better in the market by buying a low-cost index fund on the S&P 500. Again, the same story. I said, yes, you totally can do that. But what is the purpose of the money? And she goes, well, I want to start growing my investments. I go, okay, but do you see the value in still having life insurance coverage? She goes, oh, yeah, no, I do see the value. I go, okay, let's take a look here. How about if you're dead set on doing this other investment strategy, why don't we take what you've already built inside the life insurance and when we transfer it to another policy that's designed not so much for growth, but more simply for the pure aspect of the life insurance benefit itself. So you upgrade, you move your cash over so you don't lose your cash. It's not like it's all going away. You're simply going to upgrade it over into a policy that's specifically designed to give the most amount of coverage and the most amount of living benefits. And then you can take those dollars differences and then redivert them elsewhere. So instead of doing $750 a month, maybe you do $200 a month like you were intending on, but now you get a much bigger policy for the purposes of coverage, not cash. And then you take the other $650 a month or $750 a month, then you can put it into the market. She goes, well, that would make a lot of sense. I go, okay, cool. Because every year that we visit, this has never come up until now. And she goes, yeah, I know. I've been changing my mind on planning. And I said, no problem at all. I mean, I'm not a certified financial planner. I help people with income strategies and insurance products, but I'm not a financial advisor. So I just said, look, I know the insurance world, and if this is really what you want to do, you understand the values of both sides, then let's go ahead and go with what you feel most comfortable with. Long story short, we got her approved in underwriting. And now we're looking at, hey, look, maybe we do a permanent life insurance policy. And she happened to be in California. So I said, let's do a permanent life insurance policy with Nationwide and then shop it with John Hancock. So I showed her two different options. And what we were able to do, the current cash value policy had right around 350,000 in death benefit, and it had about 80,000 in cash value. So what we said is, okay, if we were to move this over into a different permanent type of policy, what could we get out of it? And with Nationwide, she was able to double the coverage, and it's guaranteed. And she moves the cash value over, still has the ability to maintain that cash value, and she's only paying $200 a month. Double the coverage, $200 a month. So dramatically reducing the cost of it and maintaining the cash value. Win-win situation all the way around. And this is what we've been doing with a lot of our clients. That's why it's always important to do annual reviews, even on term life, because then there could be an opportunity to convert that or to talk more about a permanent life insurance solution. We are upgrading this policy now. And then I showed her John Hancock also. I said, now look, my job is to educate you, show you the marketplace. And with some people, you don't need to shop and show multiple options. Other people, you're going to need to because they may have a financial advisor involved in the picture, and that's the case here. So I wanted to be able to show her a full breadth of options. With John Hancock, we were able to triple the coverage, like over $900,000 in coverage, right? That's a lot more, but it doesn't have a guarantee to 100. It guarantees all the way to 86. Now, given that would be worst case scenario, but it's my job and your job as the agent to educate people on the pros and cons and the differences. Because if I were to have just shown her Nationwide, and then the other advisor comes in and says, well, look at this John Hancock, I'm not sure what he or her has access to, right? I want to be able to say, hey, look, here are the two top options. That way I know for certainty I can secure that sale, because she wouldn't go with somebody else who didn't bring up anything at all. And if I did not show the Hancock, then if that person brought it up to Hancock and she goes, this is better, then I said, okay, well, just use me anyway. Here's John Hancock. It gives me less leverage and less of a sale. So you don't want to overwhelm people with options. I mean, a lot of this comes with experience and timing things. But by showing her both, she saw the value, and I explained the pros and cons of each one. I said Nationwide offers an indemnity-based LTC rider, so you can spend it however you choose. John Hancock does not. On their life insurance, it's a reimbursement policy. You also don't have the contractual guarantee to age 100, and who in the hell knows what's going to happen to the insurance industry? She's only 60. So in 20 years from now, when she may actually need to use some of this, who knows what the cost of insurances are going to be? Remember, on all policies, excluding whole life, but on the universal and IUL side, and even on the VUL side, they have an opportunity to increase the cost of insurance. That's why you have a guaranteed ledger and then two alternate non-guaranteed ledgers. We don't know what they're going to do. Nobody thought Genworth would ever increase the premiums, and now they're increasing premiums on long-term care over 600%. So I don't trust insurance companies, but I do trust their contracts, because it's cheaper for them to pay a claim or to honor the contract than it is to go to a class action lawsuit. So they're always going to honor their contracts. So by me showing her both of those options, she's now contemplating, wow, this is really cool. She goes, I might like the John Hancock more. I do understand that it's not guaranteed, but by the time I may need it with my family's life expectancy, my current health, it's going to be there for me. And it very well may be, but my job is to show you both options. And she asked me, what would you do in this situation? I said, me personally, I would probably just go with the Nationwide because it's guaranteed forever. Okay. But that's just me. A lot of people, they say, I would rather get a lot more coverage and have different benefit features and go with John Hancock. You can do that too. So both companies are good. But remember, there's a fine line between recommending a product and then telling somebody what to do. But if you can have an educated conversation about the pros and cons of each without being overwhelming and convoluting with the client, now you have an opportunity to always win. Because if she was only shown Nationwide and I'm in a competitive situation and I want to win her business, I would show her John Hancock. And then I would still do the right thing and explain the pros and cons. Like, yes, Nationwide is guaranteed to 100. This is only guaranteed to 86. But in order for that guarantee to actually have any validity, the highest cost of insurance possible would have to be played out. And In addition to that, it would have zero interest for the next 30 years. So how likely is that to happen? Not very likely, right? So the point of that is when people are trying to compare self-insuring with doing the market side of things, you always have to reiterate to them, you are still self-insuring with insurance. It's not free. Nationwide, John Hancock, whomever, they're not going to just give you a policy. You're still self-insuring, but you're doing it in a tax-efficient, guaranteed, and leveraged manner versus investments, which is good to have investments. But with investments, they're non-guaranteed. The majority of them, excluding a Roth, are 100% taxable, like your IRA. And if it's a non-qualified brokerage type of account, there's still long-term capital gains there. And then people will come back as a follow-up objection and say, well, yeah, but when I'm older, when I'm retired, I'll be in a much lower tax bracket. I go, oh, really? Okay, cool. So you don't think taxes are going to change in the next, say, 15 to 20 years? Oh, they'll probably change. I go, do you think they're going to be higher or lower in the future? Most people say, well, they're probably going to be higher. I go, okay, great. But, that only affects the top tier brackets. It won't affect the lower brackets. I go, oh, that's interesting. Just in this most recent tax bill, it affected all the brackets. So we have a variable there called the government that has full control over all the levers of taxation, okay? And so if you were to base everything on just pure investments, you have to take a look at volatility. What happens by the time you actually may need this and the market goes through a massive 40% correction and you lost 40% of your wealth in a very short time frame? How would that affect how much money you could get in the future? And in addition to that, losing the 40% due to the volatility, you're going to also have taxes, which depending on your state can equate to anywhere between 20 and 40% as well. Oh, wow. So almost 80% of their portfolio could be gone just between your business partner, the IRS, and a massive correction. And they go, I never really thought of it that way. I go, yeah, I mean, this is worst case scenario stuff, but it has happened multiple times throughout history. So what's stopping it from happening again? And do you know when it's going to recorrect? No. Did your financial advisor know when it's going to recorrect? No. That's a good point, because if they knew when it was going to recorrect and they could time the market, they wouldn't be talking to you or me. They'd be on a private island somewhere. Okay. So if we look at here, over the last 5 years, the S&P's done really well. Okay. But if we look at the max, it always goes through these different cycles. And so when I show people, especially that are getting closer to retirement, I go, the S&P in the year 2001, where is it? Where is the 1500 at? No, sorry, year 2000. It was right around 1500 points. Okay, then it tanked. And don't worry, it always comes back up. It came back up to 1500 again, took 7 years. And then it tanked again in 2008. And then it came all the way back up to 1500 again in 2013. So that's 13 years of just breaking even. And most people aren't even invested in the S&P 500 100%. 13 years just to break even. That's like $40,000 loss in inflationary costs if you adjust it. That's a long time. What happens if you're going to go to retire and history tends to repeat itself? Does that ever occur to you? Does history seem to maybe not identically repeat itself, but mimic itself? And she goes, yeah, that does make sense. I mean, hopefully it doesn't happen. But if it does, it's much different when you're younger and you can wait these recession periods out. It's a whole other world when the market tanks. Let's say you go from 1500 and you went all the way down to 826, and then you needed to take out money for long-term care or for life insurance purposes. Your family had to spend it down. How long would that actually last? And then how much of that growth would you actually have in your pocket after they paid the tax? So when people say, well, I have $2 million in my 401k, I go, great. You really have about 1.5 million. The other $500,000 is your business partner, the IRS. So you got to get people to understand the government systems, because that's something that's set in stone that they create, and be like, look, you do have sufficient assets, but how much do you actually have that your family could use? And what's the value of that going to be in the future? I mean, if you do some inflationary calculators, it's pretty scary. Most people are break even, especially in the last few years when inflation was like over 8%. And that's what they're telling us. That's a consumer price index inflation rate. That's not like the real dollar for dollar cost. Look at your grocery bill from this year, from last year. Okay. So you got to create ways to mitigate the risk inside of a portfolio to help people understand, look, investing is great. You should be investing. You should be building for your future. But at the same time, you can't have all of the eggs in one basket. If something happens to you, the least expensive way to create the most amount of money is through insurance. Again, I repeat this all the time. I ask people, it's like, look, it depends on their age. Like if they're in their 40s or 50s, most people don't have their house paid off. I said, if your house was paid off today, 100%, would you buy homeowners insurance? Oh my God, yes, I would. Absolutely, I would buy homeowners insurance. Oh, okay. Do you think it's more likely that your house is going to burn down to the ground or that you're going to get old and sick and need help and pass away? Which one's more likely to happen out of all those three? Yeah, I'm going to get old, slow down, I might need some help, and I'm eventually going to pass away. So why would you even want homeowners insurance? Why would you waste that money? And that premium, by the way, goes up generally every year. Why would you waste that money? You're going to invest in the stock market. You should take your homeowners insurance premium, the $2,000, $3,000, $4,000, $5,000 a year, and invest in the market. Put it in here, and this market will grow. And if your house burns down, you can just sell off a big chunk of the stock portfolio to rebuild a new house. And they go, oh, I wouldn't want to do that. It's really weird how people think. But if you can relate it to simple stories like that, it really helps them grasp it and understand it. Okay. So then I go back again. I say, you're still self-insuring with insurance, whether it be long-term care or life insurance, you're still self-insuring. You're giving them money. And the same applies to the annuity as well. I just helped a lady out yesterday. We did another rollover. So now, so far this month, we're almost at $2.8 million in rollover premium. And we're only, 11 days into the month because of simple conversations like this. She goes, my Vanguard index fund has done phenomenally well. I go, yeah. She goes, Vanguard's amazing. I go, Vanguard is pretty good. But my daughter, she's only 6 years old. Did you know that if she put the same amount of money in the Vanguard fund that you have, she'd have the same return? Or maybe she used Fidelity or Schwab or Merrill Lynch and just bought the same funds, she'd do the same. And she goes, oh, that's a good point. I said, look, the point of that is we're all benefiting right now because of the artificial creation of fiat currency money that they keep hyping up the markets with. It's great. Now, it's not because of, necessarily a wise decision that you're making by buying an index fund. It's just because we're all tides rise together if you own an index fund like what she had, right? I go, but it's not always going to be that way. Do you think it's always going to keep going up and up and up? She goes, no, it probably won't. I go, wouldn't it make sense that if you could still get to benefit from some of the growth, maybe not all of it, but some of it, but not lose anything and not pay any fees at all? She goes, well, yeah, if that ever existed. I go, well, let's say it did exist. And this magical plan said that you could have the ability to earn up to 10% of what this S&P 500 index does on a price return. But if it goes down, you don't lose anything and you don't pay any fee. And all the money and the interest that you earn in the policy is always guaranteed and locked in. Would that be of interest to you to be able to get up to 10% but not lose anything? Yeah, that would be pretty good. I go, yeah, that's going to create an average of about 6.5% to 7% return depending on the market timeframes. So right now in your current policy, are your current fund investment, will you lose money if it goes down? Yeah, I will. Okay. What about what you're telling me is you're still losing if it goes down and you're still getting an upside, but you're still losing when it goes down. She goes, yeah. I go, okay. Well, wouldn't it make sense out of all of the money, you just take a small portion, park it here where you don't lose anything, and you can average a higher interest rate than any money market will pay or any CD. Would that make sense? She goes, yes. I go, great. Let me show you how it works. Then we got right into it. So it's a little bit harder when you're dealing with index fund to index fund. However, most people don't have 100% of the money inside of the S&P 500 index. Where they have it is in mutual funds. And so the story I show with mutual funds, I go, look at the markets. Look at year to date, man, 8.9%. Look at 1 year, 25% return. I mean, I buy index funds. I have a Fidelity account, and I've done really well. I mean, I've done 25% because it's virtually the same thing on the Fidelity index fund. But I said, okay, have you received 25% return in your portfolio? Let's take a look. And we take a look at it all, and they're nowhere close to that. They're like 7, 8% on mutual funds or other different investments. I said, so what you're telling me is that you don't get to benefit from the full upside of what, say, the S&P 500, but yet you still lose on the downside and you pay a fee even when you're losing. They go, yeah. I go, well, what if there was a way not to pay a fee, benefit from the upside to a certain limit, but never lose any money if it goes down? Huh. And based on your averages here, I mean, I can't advise you on buying stocks or bonds, but based on your averages here compared to what this can average, it's pretty comparable. In fact, this is actually averaging a higher rate of return than what you're getting now, and it doesn't have any fees or risk. Which one would you rather have? She go, well, I would rather have the one without fees or risk. Okay, well, it's still good to have monies in the market for liquidity purposes and other purchases, but how about we just diversify a little bit of that? And when I take that approach with people, I tell them straight up, I said, most advisors, they're going to try to manage all of your money at once. I said, I don't think you need that. I said, I would encourage you to research index funds at Fidelity or Vanguard just to make your own decision to see if it's worth it. But why would you not want to put some of this money here? And why do you think you haven't heard about it? And then they go, I don't know. Why didn't I hear about it? Why isn't it all over the news? Why isn't all these advisors talking about it? I go, because there's no fees. We get paid one time, right? And a lot of people are intimidated to share their commissions about annuities because the average commission on the street level is around 7%. And it sounds like a lot of money. Oh, wow, 100 grand, you're gonna make $7,000. Yeah, one time. And now I have a a fiduciary responsibility to work with you for a decade. So really, I'm making less than $1,000 a year for the next 10 years to help you and be of service to you. It's not that much money. Imagine if I was getting 1% of that, and then it would compound and grow every single year. I would make far more than $7,000, way more than that. That's why advisors don't generally talk about it. It's also a difference of philosophy. And so when I help explain that to people, and I do it in an educational format and not trying to get the sale, but simply offering them a solution and asking them before I show the solution, would this make sense to you? Would this be something that you'd be interested in? And if you could own a portion of this type of planning, would you want to own a portion of it? And then there's all yes, 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 yes. And then when I tell them it's an annuity, I don't have any objections. Yeah, it's an annuity. They're like, oh, like this. I had a lady earlier this week said, oh, I don't like annuities at all. I go, oh, okay. So you don't like Social Security? She goes, what do you mean? No, that's a payment that I earned. I go, yeah, but it's an annuity. So are you not going to turn on Social Security ever because you don't like it? No, I'm going to turn it on. I go, okay. So you do like some annuities, right? You like Social Security. She goes, well, yeah, I guess you're right. And then she had a pension from the federal government, which she actually paid into Social Security tax. So there's no penalty there. I go, what about that pension? Are you going to just not turn it on? She goes, no, I'm going to turn it on. I go, do you like the fact that you have a pension? She goes, yeah, I do. I go, if you could go back in time and talk to your employer and say, hey, look, I want a 401k and I don't want a pension at all. I don't want a guaranteed payment for the rest of my life. I want to take my own chances and risk money in the market. Which one would you have chosen if they give you those two options? Would you have chosen the pension, or would you have invested it all into the 401k? She goes, I would have chosen the pension. I like the idea of getting a guaranteed paycheck. I go, okay. Do you know that pension, it's an annuity? Oh, really? I thought it was a pension. I go, yeah, it's an annuity. It's a payment for life. Okay. And it's wrapped up in all kinds of insurance contracts, what all pensions are. I said, but did you know there's an opportunity that you can own your own pension, your own annuity, and have control over the asset? And if you pass away, your family can get back whatever you don't use. It's protected from market volatility, and it can give you a higher payout ratio than most pensions can today. No, I didn't know that. I go, well, yeah, because a lot of times people think of annuities and the negativity automatically pops up. They think of variable annuities with super high fees. They think of SPIAs where the money's locked up, the family never gets it. That's all changed. Do those policies still exist? They do, and they do have a place and a time for themselves. But the majority of people like the idea of having access, not being locked into a contract for life, being able to get a guaranteed paycheck and not lose any money in the market and not have to pay an advisor constantly for support. And so we give you lifetime support. We don't charge you. We get paid one time by the company that represents it. And you get all of those benefits that you already like. Just because it has the name annuity doesn't mean anything. There's over 1,000 different varieties of annuities. It's almost like me saying, I don't like stocks. Really? Are all stocks bad? No. Would you be mad at yourself for buying Amazon 12 years ago? Probably not. So you can't classify the word annuity with a single solution. There's thousands of different variations and varieties and structures and way they pay out. And when I share that with people, It really helps open their mind up. So I hope that was helpful in relating to self-investing versus the S&P. I can take care of it all myself, blah, blah, blah. I mean, we have clients that are worth hundreds of millions of dollars and they still buy long-term care because they're smart. Why wouldn't you, right? Okay. The other thing I'll mention here quick before we wrap up, if you have any questions, you can drop them in the chat. The other thing I wanted to mention is that you need to own these products yourself at some level, okay? Because if they ask you, and this will happen, do you own life insurance? Do you own long-term care? Do you own an annuity? No, I don't. I'm not going to buy that shit. You can't say that, right? You need to own it yourself. That way you can say, yes, I do. I show clients my annual statements of annuities. Okay. I say, like, for example, right now, Gillico is really hot, right? They have great income, great growth. I'm buying a Gillico annuity contract after I close on this new house because I can't even buy crackers at Walmart right now without them finding out about it. So I'm waiting until I close on this new house, which will be done at the end of this month. And then I'm going to go ahead and buy a Gillico annuity for growth. I can't buy it for income. I'm too young. So I'm going to buy it for growth. And the reason why I'm buying Gillico is not because I love Gillico. It's because I'm selling it right now. I know it's going to be a hot product for quite some time. And I want to show people like, look, I even purchased this. I put my own money into it. Okay. This is how good of a deal it is. I put my own money into it. I could buy anything I want. And I bought some of this product along with a lot of other companies. So you take ownership in what you sell, even if it's $5,000. I put $5,000 into Sentinel just to have something. Gillico, I have to put 20 because that's their minimum. So even if you're on a tight budget, go to like Gillico or Atlantic Coast Life. I mean, they'll sell, you can get an annuity for like $5,000. There's certain companies like, I think North American might still do this. It was like $2,000, but own some level of what you're selling. That way it's more relatable to the client and it'll build your belief in it. Because if you truly believe in these products and solutions, which you should, the more you become educated about them, the more that you're going to want to own them personally for yourself. And the more that's going to help you with the sales process. So I hope that was helpful. Next week, next week we'll still have the Academy call, and same with the week after. We're going to be in Medicare Con. So if you're going to Medicare Con, it's going to be fun. I'm going to be speaking main stage there with Justin. And we're also going to have a panel. It's all going to be about the exhilarating topic of long-term care and annuity cross-selling. But it's going to be a good event. There's supposed to be about 1,500 agents there. It's crazy. Linda, can I get the recording? This recording or with the recording at Medicare Con? I think you're assuming this recording. Yeah, you can. So if you're an Academy member, I save all of these recordings inside there. I mean, they're literally hundreds of hours in there, including custom seminar training, different topics, variations, carrier updates, product updates, everything that's inside the Academy. And again, it's $97 a month, and I'm not trying to retire on that. In fact, I make very little money on that, if anything at all. But the platform that we use to host all these, they charge us a ton of money. So we basically just translate that cost down. So if you want access to all the recordings, $97. You can cancel it at any time. Doesn't hurt my feelings. But it's totally worth it. For less than $100, you can go in there and watch all these different solutions. And I have videos on how to cross-sell life insurance, how to do even advanced trainings too, where we're talking about irrevocable life insurance trusts. And that's a whole other recording I did where you can work with attorneys. And the average premium on those policies with high net worth clients are $40,000, $50,000 a year in premium is our average, between $40,000 and $50,000 for life insurance. It's more than just selling term or final expense. Okay, you can translate your knowledge in life insurance, go work with an attorney, say, look, I write the life insurance for irrevocable trust. If you need somebody to be an insurance representative, I'd love to work with you. And guess what? Attorneys can't take commissions. So you get to keep it all. It's even better. Okay, so think about that stuff. Thank you so much for everyone hopping on, and we'll talk to you soon.